It's time for our last panel of the day. I'm Christine Gregorak. I'm partner at the Real Estate Law Group in the Bay Area. The last panel, real estate financing trends, debt, equity, and everything in between. It's always a relevant topic, particularly interesting today with multiple sources of capital, chasing every deal, innovative financing mechanisms available today that, quite frankly, were not legal a few months ago. There's lots to talk about. I'd like to introduce to you today our moderator, Tony Taranto. Tony is a partner in the corporate real estate and energy practice in Sheppard Mullins, San Francisco, and Del Mar offices. Tony has a diverse real estate practice with a focus on real estate financing. He serves as primary outside corporate counsel for many companies ranging from multi-billion-dollar financial institutions to small family offices. Tony?
Thank you. Thank you so much, Christine, and thank you. It's wonderful to be here today and to see so many familiar faces and also so many new faces. Let me also say it's very exciting this year to see the attendance that we've had. I think next year looks like we're probably going to need a bigger house, which is particularly terrific. Also, just one comment on the prior panel for Professor Hall. I thought it was fascinating, although I also think that the Post-it notes he has on his refrigerator are quite different from the ones that we have on ours. He and his wife are solving the world's economic problems, and my wife is like, take out the freaking trash, or, something like that. So anyway, I was glad to see how other people live sometimes. So I'm delighted to be here, and as Christine said, I'm a partner at Sheppard Mullin. I have quite a diverse practice, and a lot of it specifically and very deeply in real estate. And it is development related, joint venture related, and also very heavy in finance. And so I'm proud of that. And also, before I go on too much further, I know we're the panel that's standing between all of you and the cocktail reception as well. And so there is a cocktail reception afterwards that Sheppard Mullin is hosting, and so we hope you will all stay and join us for that. So thank you very much about that as well. It's a special thing for me to be here in that I have a deep connection to Stanford. I went here as an undergrad and also came back for grad school. And so being here in the community, and actually, though I won't embarrass him by calling him out, there's actually one of my undergrad classmates is here today. Some other folks I know from business school as well. And so it's wonderful to be here and to see, to be back on the farm. But something else about this is, and very apt, I think, for real estate development, and I know the Stanford world operates in a different way, but if you leave this campus for just a couple years and you come back, you won't recognize the freaking place. Right? I mean, the number of buildings and the kind of development and the kind of motion and the kind of activity and dynamism that goes on here really changes the landscape, and it drives home how important real estate and real estate development is, how it changes our spaces and changes our lives. We've heard a lot today and had a bunch of wonderful, exciting panels and discussions. Those have come from, we've been talking about Silicon Valley and millennials. We've heard about how you organize and build out spaces to make use of it with people and time for efficiency purposes. We've talked about monetary policy and the broad economy from that academic perspective. We've heard from city managers, we've heard from developers, we've heard from economists and other experts. But now we're going to not zoom out to the level of monetary policy, but also maybe not zoom into some of the level of the local political dynamic. We're going to move out a bit, though, because all of this, in zooming out, takes place in the context of the capital market and specifically access to capital. And we have here today a very distinguished panelists, series of panelists we're very grateful to have, who provide that capital to help finance projects, both in some cases on the equity and on the debt side. So we're very fortunate to have them here today, and let me introduce them only very briefly, and then I'll let them each give an introduction in more detail for themselves. Immediately to my right, we have Rocky Freed, who's managing member of Farallon Capital, and he invests across a broad range of real estate assets, and I'll let him elaborate on that. Mike Jameson is immediately to his right, Managing Director of Prudential Mortgage Capital Company. And it's Mike and I worked together for quite some time, going back years actually. So it's good to see you, Mike, and thanks for coming. We have Cynthia Lavelle, Executive Vice President and Division Manager for Commercial Real Estate at Wells Fargo Bank. And then also we have Jim Martin. And Jim is the Director of Commercial Real Estate Bridge Lending and JV Equity at Sabal Financial. And so with just that very brief introduction, I'll pass it along, and we can just go down the line here, Rocky. You can go first and give maybe a little bit more of an introduction for yourself and talk about Fairlawn.
I was trying to think of the Stanford connection, and then I realized that Fairlawn's running a refugee camp for all of you fine graduates.
And we're grateful for it.
Yeah, so. I am apparently the only non-Stanford person at Fairlawn, I've been told many times. But Fairlawn has been in the real estate business since 1993. Fairlawn is a nearly 30-year-old hedge fund based in San Francisco. It's a global operation. London and Singapore seem to actually make up a lot of our investing right now. I run the U.S. real estate business. We do some things overseas that's not under my purview. We manage a few $1 billion of equity. It would be broadly called opportunistic. We do some higher leveraged debt, but it's primarily providing equity for broken transactions and balance sheets and trying to fix them up and sell them to more institutional capital.
Mike?
Sure.
Yeah.
Mike Jameson, Prudential Mortgage Capital. If I'm too close, sorry. I've been with Prudential longer than I want to admit, and I'm not as happy to be at Stanford since I'm a bear, but we'll forgive that for a moment. Prudential is a large, large investor in the commercial mortgage space. Last year we did about close to $16 billion overall, and our general account did about $9.8 billion. We invest in all sorts of food groups in terms of property types, all the standard, office, industrial, retail, and apartment. We do some self-storage. We do a little bit of senior living, but for the most part, we pretty much stick to the usual suspects, if you will. We focus on major markets. A lot of our portfolio, which totals almost $40 billion right now, is in the major markets across the country: New York, Boston, Bay Area, Los Angeles. And the majority of our borrowers are kind of household names. A lot of the large retail operators of dominant malls, a lot of the REITs, pension fund managers, and those kind of investors. Unlike Cynthia, we're typically a non-recourse lender, invest in permanent loans pretty much exclusively. We have a little bit of floating rate debt, but pretty much we're investing for 5 to 25 years. The typical in our market is about 10 years. And we're pretty conservative, as a couple of people in the audience can attest to. Spreads today, just to give you a rough idea where we're talking about, I think the 10-year Treasury is about 275 today after coming down with some of the issues in the stock market and overseas, emerging markets particularly. But today we're roughly 150 to 200 basis points over the Treasury rate, so you're talking low to mid 4% range for the kind of everyday deal.
Thanks, Mike. Cynthia?
Hi there. Thanks for having me. My name is Cynthia Lavelle. I'm with that small bank, Wells Fargo. I've been with Wells for about 20 years. Most of my career spent in real estate, and I manage our Bay Area commercial real estate portfolio in our Pacific Northwest. So I'm fortunate to be in two of the best markets in the country, this area and Seattle. We do mostly interim financing, 3 to 5 years. We do both recourse and non-recourse. And in addition to what I do and my colleagues do, we've also got other buckets of money, wealth management being one of them. CMBS is another. And so we really cover the spectrum. Just on the balance sheet this year, out of the group I'm part of, commercial real estate, we put out $30 billion. That's across the country and in London and Canada.
Thank you. Jim?
Hi, Jim Martin. I'm with Sabal Financial, based in Newport Beach. And the company was founded in 2009, so quite new compared to these folks. And our core business is we were founded to buy distressed debt in pools, and a lot of people talked about that business, and Sabal executed it on behalf of institutional capital, and over the last few years has acquired 25 plus pools, about $5 billion of distressed debt. And we were unique in that we focused on niches that were out of favor, namely land and small balance CRE pools. So it has been some very fruitful days of harvesting because there was not a lot of competition in that space, and it turned out to be very nice yields. That business, of course, is sunsetting, so the company has taken its employees, which were about 35 when I joined in mid-11 and now about 200, and moving it into other businesses. We provide capital, which I'm a part of, in the home building arena and in commercial real estate, and we also have service businesses like due diligence services, bank credit advisory, outsourced loan servicing, that kind of thing.
Thank you, Jim. So I think it's clear from what you all just heard that we have an extraordinary, we have a broad and deep spectrum of experience here, and a lot of different types of lenders, and in some cases also equity investors. So I think part of the focus today is to use this time to talk about the market today, really its challenges and also its opportunities. So let me start by putting a question to the panel about really how would you characterize the market today?
From my vantage point, I'd say, especially here, and we might be in a little bit of a bubble in terms of the Bay Area, and notably Silicon Valley, incredibly strong. Prices have increased dramatically, returns have come down. So here we see, unbridled strength, and maybe worried about some bubble issues here and there in certain markets. Other parts of the country are a lot tougher. And, the return differential is interesting in terms of what you can buy here versus what you can buy in other parts of the country, especially in the Midwest where things are a lot tougher.
Go ahead, Rocky.
Yeah, I would echo what Mike said. I would say, generally speaking, we're in a recovering to recovered market. I mean, Silicon Valley, Bay Area is certainly covered. But if you go outside the sort of top 6 or 7 24-hour cities, there is some yield. And then in product type is really where people are having to stretch. If you're willing to buy B, if you're willing to buy suburban, B malls, stuff that's a little more esoteric, you can get some yield. But generally speaking, people are starting to complain about East still being too busy, and you always know that that's a Wells Fargo company. That's always a sign that the market is very hot. So you're hearing a lot of complaints about them right now. So that would tell me that we're well into a recovery.
I would also add that for the first time in 25 years, there's a high-rise office building under construction in downtown LA, so that ought to tell you the market's back. I would say in my 25 plus years, it is one of the best, maybe the best borrowers markets I've seen, with capital awash for just about any property type, any business plan. So I would say the market is very healthy.
Cynthia, do you have a view on that as well that's any different, or anything to add?
Yeah, I think that's right, and I think it is very borrower-friendly right now, although it doesn't feel crazy. There's still a lot of equity going into deals. Lenders are still getting some structure. The owner or the debt stacks aren't complicated like they were kind of in the 2005 timeframe. I mean, that's coming. You're starting to see more subordinate lenders in the market, but. Right now, I think we feel pretty good. We certainly feel good about the book of business we have, and feel good about the Bay Area.
So a robust market, but still pretty rational.
Yeah, I think that's right.
And so we use this analogy. We had a little pre-call in advance just to discuss some things for the panel. And one of the questions was, if this was, this cycle were a baseball game, kind of what inning would we be in? Where do we see this kind of going and playing out? So what are your thoughts about that?
Well, as a lifelong Kansas City Royals fan, baseball analogies are tough for me. I feel like we're in the bottom of the ninth, down by 5. But but I would say that I really look at the words that the industry pros are throwing around, and words like hope and optimism and thrilling, and in this part of the world, exuberance and rational, I might add. I've replaced words like panic and fear and despondency. So to me, it feels like we're singing "Take Me Out to the Ballpark" in the seventh inning stretch, which I think it will be quite a long time. As I think the markets, as Cynthia pointed out, there doesn't seem to be too much craziness, even though the markets are clearly on an upward swing.
Yeah, my sense is, at least here, we look like we're in the seventh or eighth inning, but it may be a double hitter if interest rates don't go up. I don't know. It seems the Fed's very willing to keep them low, and that will help sustain this really strong market we have.
Yeah, I actually think we're before the seventh inning, because everyone knows in the seventh inning they take the beer away. And I haven't had a problem getting a beer for years.
Great for the cocktail party.
And yeah, right. And the other reason that the beer is still available is we went through a period where there was no building, and I know when we drive around the Bay Area, we see buildings going up everywhere. But other than downtown LA, I mean, you go to Orange County, there's one building going up. I mean, there's other than residential product around the U.S., there's nothing getting built except in the New York, San Francisco. So I think that means it's early because the supply has been so dampened.
Well, and so there's a mention here about interest rates, and obviously, well, I ask you to dust off your crystal balls a little bit. In any event, nobody knows what's going to happen, but how are you thinking and planning about what you think may happen, or your sort of contingencies for the future as it relates to possibility of, well, they're not going down. So, and what are your thoughts about maybe the time frame in your own companies and businesses as you're making lending decisions about when we might see changes?
I'll go ahead. We talk about interest rates a lot. We're short-term, for the most part, short-term lender, and so probably don't have a lot of as much of the concerns that Mike has, but we're floating. So we're typically just asking clients to hedge or requiring it, certainly on anything beyond 3 years. Also, we've changed our structures slightly. We had been using just simply a debt yield test, and we've incorporated a debt service coverage ratios in our covenant structure, to capture rising rates.
I spent the better part of the last year talking to limited partners trying to raise money, and it was always the second or third question they asked was, where are interest rates going? And I always said, if I knew that, I wouldn't be here. But they cared about it in correlation to really what's going on with cap rates.
Right.
And my answer for that was that, certainly, you're generically speaking, we're in a 6 cap rate world. I mean, obviously, in the Bay Area, we're in better than that, but generally speaking, we're around a 6 cap. And I said, it's not going to get any better than that. But if you look at the historical relationship between the risk-free rate, or 5 to 10-year treasuries and cap rates, it's actually pretty darn wide compared to the last 20 years. So my view on interest rates, if interest rates go up because we're creating jobs and there's economic vitality, I think cap rates won't move that much, and I think it will actually be a positive. I think that there still is, $1.6 trillion of debt maturing over the next 3 or 4 years. That was another thing we always trotted out. And it will be bad for some of those borrowers who've been kicking the can down the road and holding on by their fingertips. But I think that for the well-capitalized people and the people who have bought recently or in the market now, lenders now, I think that it'll mostly be a non-event unless we're, in Jimmy Carter land.
Jim, what do you think about how cap rates may move in connection with interest rates, or not?
There's a lot of talk about that, of course, that as cap rates rise, or as interest rates rise, cap rates will be linked to them. I don't see it as a real concern, frankly. You look at the historical norms, and cap rate spread over 10-year Treasury is about 300 basis points, and right now we're 500 basis points, plus minus. Plus, cap rates are a function of a lot of things, barriers to entry, projected economic growth, real estate fundamentals, space markets. I think all those things are very positive. So I really don't see a huge increase in cap rates, even if we get an increase in interest rates. And I think The thing with interest rates, by and large, anyone who has elderly parents in this room knows that there's such a demand for savings with a global aging population that I don't see rates really rising dramatically. I just think that that's a force that will just keep rates low, much more demand for savings than borrowing. So interest rates don't really concern us.
Interesting. And Mike, as an investor with a long time horizon when you are making your real estate bets, what are your thoughts about it?
Yeah, I think relative to Cynthia and Wells, our liabilities are very long-term, being an insurance company, so we're a little bit more agnostic. Having said that, low interest rates are kind of the bane of insurance companies' existences right now, so it creates a challenge. I think I would have thought a year ago with the economy improving, it almost requires interest rates go up, but it seems like the Fed is really interested in keeping them low, maybe too long, and I think that's as big of a risk that they get, remain low too long, and then we have more inflation than we can deal with.
So let me move from there a little bit. The topic came up before about this being a borrower's market, but also maybe some interest in different asset classes. So to what extent are you seeing different product types and different asset classes really being drivers for you, and which ones do you see being the strongest ones right now?
That's easy. It's multifamily. I mean, everybody wants to build apartments right now. So I'd say probably a third of what we originated in the Bay Area was construction, and probably 80% of that was for multifamily.
Is that the same for everyone?
Well, we look at this, we call it the 4 basic food groups, retail, office, multifamily, and industrial. And when you're trying to make higher rates of return, which is our mandate, you can't really be investing in industrial. We really aren't pursuing development strategies that takes apartments off the table. So we're having to look at, I would say, secondary markets more than product types, although there are some esoteric things that are showing up, on our screen. We haven't done any of them yet, but the one asset where if you really are looking for yield, where you can get yield today, are in these B malls. That's a scary business if you have a belief, which many intelligent investors do, that Sears and Penny are not long for the world, and they're in every single B mall. So that's if you have 4 anchors and you lose 2 of them, the math doesn't really work. So we are trying to branch out, but it's a value trap situation. If you do something too esoteric and you do have that hiccup in interest rates or job growth, you're going to be stuck in it, and that's not good.
Yeah, I think to me is interesting is just how all the 4 basic food groups are changing. I mean, in office you have efficiency and parking ratios, as Rock and I were just talking about earlier. How as the demographics change, how does the suburban office work? Where do people want to work? Retail, the internet, industrial, Amazon. How does that whole distribution model going to change? And multifamily, just a lot of buildings. So I think it's going to be a challenge for all of us to really get our hands around how the world is changing and how we look at the existing property types differently.
Right.
Yeah, I agree with that. The Gen Y, there's a lot of talk about that. I think it's 70 million strong, and kind of the age 20 to 35 and how they live and work and play differently than previous generations, and the type of real estate that they like creative office and apartments with probably small units but large common space. They want it now, so that would lead you to believe you want to do warehouse space that's efficient in urban markets. So the trendy answer is all the asset classes that sort of play to the modern society, and we certainly like those, but the real world is, we're looking really hard asset by asset, space by space, and stressing it, and we'll focus on those assets where we feel like there's minimal downside, but decent amount of upside.
And what about term versus construction financing? I know, Cynthia, you just mentioned a bit ago the construction financing that you do, and Mike, obviously you do almost exclusively term, but Rocky and Jim, to what extent do you see the opportunity also for term versus construction? And maybe also, Cynthia, how much Well, I guess, how much demand are you seeing for the construction product versus term?
Well, Sabal on the construction side has a single-family townhome construction group that is very active in select markets across the country and infill sites, providing up to 85% loan to cost on a non-recourse basis. So we like residential construction. It can be phased. You know, it's a home. They can be monetized. We haven't gotten there yet on CRE, on income producing, and I think that's a function of our DNA as a distressed debt buyer. We're so used to being so far below replacement costs that when you're, you know, a construction lender or certainly building as a JV partner on a construction deal, you're at replacement costs. So we're not there yet on as it relates to income property, but very, very active in the single family space.
Well, we're more of borrowers than we are lenders, I would say.
That's where you want to be, as a borrower.
As a borrower, we love the LIBOR fairy, as we call her affectionately around. But we're borrowing short term. I do think that long-term fixed rate debt is being considered an asset in the marketplace right now, and that's a slippery slope. That reminds me of 2007, where, you know, the more debt you could get, the better it was. But it is a great time to fix in rates. I think we can all admit that. But we tend to buy things and try to sell them. And so, particularly in CMBS land, it's gotten extremely hard to deal with special servicers and to try to assign existing debt to new borrowers. They're very slow. It's very cumbersome. We've really embraced balance sheet lenders, people that you can talk to, and lower loan-to-value, non-recourse floating rate debt. That's the way, you know, when we hedge it with caps. We think that that's the way to go in today's market. If it was for my own personal account and I was going to own it forever, I would, you know, borrow from you. These guys right now, because 4% is pretty darn cheap in my 20 plus years in the business. I would say as a lender, we're truly a lender of last resort. We don't talk about spreads because, you know, I don't care if it's 400 or 500 over, it's still single-digit rate of return, and we're not getting paid for that. So what we're trying to do is create where we don't plan to own them, but create it at a basis where we feel totally sick to our stomach if we had to own it, and get paid a double-digit rate of return. I would say that, you know, we've done 3 deals on the lending side in the past 2 years, so that tells you how much demand there is for what we're offering. But once in a while, you'll find something where you can differentiate. I think it's hard to differentiate yourself in the real estate business. I think telling the truth is one way. There's a lot of lawyers in here, right? You should have laughed harder at that. And then the second way is understanding complex balance sheets. And Farallon, because we have a bunch of different disciplines outside our core real estate area, we're really able to understand complicated, or as we call them, story credits. So that's really been our only opportunity.
Thanks. And Cynthia, you had mentioned just a minute ago how much multifamily is a portion of your portfolio, and you mentioned construction financing there. How much is construction financing, or how often is construction financing involved when you're dealing with originated loans now versus term debt?
Yeah, so I pulled those numbers. So again, this is for the commercial real estate group across the country. We originated about a third construction this year, or last year, about 40% standing or term debt, and then about 30% lines of credit. And so that includes the public companies as well, which I think the bulk of that would have been to REITs.
Right.
But I just want to go back up to the construction financing for office, for example. I mean, that's another reason I guess I'm still feeling relatively optimistic about these markets, is because there's not a ton of construction available for projects that don't have tenants. And so you're not seeing a lot of spec construction going on, at least financed spec construction. And the few that have occurred, and we've done 1 or 2 of those, it's very sponsor specific, and it's very market specific, and it has a lot to do with guarantees. So, I don't think Wells Fargo is unusual. I think the bank market right now is still pretty cautious. Whereas there's a ton of apartment construction. If you look around, again, there's not a ton of commercial being financed being financed on a spec basis. That's a good thing.
Well, you just mentioned the G word, guarantees. So an interesting topic is the extent to which there's more non-recourse product in the market perhaps now than there might have been just 18 months ago or so. I know we talked about that to an extent, and some of you have had non-recourse product all along through the downturn. But to what extent are you seeing more competition, I guess, in the market in that respect?
Well, I think, having that guarantee, that recourse is always a great hammer, for lack of a better word, for a lender. But at Sabal, we've always been a non-recourse lender. We're very real estate focused. That's where we put our emphasis. The real estate is always going to be there. We can't really control what that borrower does in his or her other activities. So our focus has always been on getting to know that real estate very well. But I will say, as the market has clearly has a lot of momentum, we're seeing more and more aggressive requests. The most common one is, hey, I want to put an entity up as the carve-out guarantor rather than a warm body. And most recently, we've heard, hey, the only carve-out I want has to do with bankruptcy. I want you to waive misappropriation and fraud and everything else. But, if I do file BK, then there will be springing recourse. So no question the market has quickly moved in a direction where, non-recourse is the name of the game, and trying to get as aggressive as they can.
Wonder how far some of those conversations go.
So far with us, who said this is our standard carve-out language, do you like it or not?
Right. Any other comments on that?
We do both recourse and non-recourse. I mean, sometimes clients are more than happy to put up a guarantee, certainly on the private side, because they feel, and they'll trade the guarantee for maybe better pricing or more proceeds. So we do both. We're comfortable with both. The structures will just be slightly different, and and again, on the sponsor side, I would say the institutional, the funds like a Farallon, I think are much more non-recourse oriented.
We haven't really ever been a recourse borrower, and I would say that the pickings were really slim when you were looking for a loan 4 years ago. It was basically Wells Fargo, and they were great.
Commercial.
Right, Sean? And then I would say now there's a lot more competition. There's a lot of non-bank new entrants back into the business, and they're all non-recourse. And there's a few more banks. There's a lot less banks than there used to be. So there's clearly fewer people to choose from. And we are getting the banks that are coming back into the business. And we're a 50 to 60% LTV. We'll buy something vacant. We'll try to put a little bit of leverage on, in the low 20 to 30% range. And then all the good news money, we'll try to leverage that. And the banks who are coming back into the business are still asking for some limited recourse, not full recourse. We haven't been doing business with those guys because we're reluctant to be recourse.
Well, you just mentioned something else that I think is important to cover, and that's the emergence of a bunch of non-bank and non-traditional financial institutions as sources of capital, right? So it's the non-banks, and sometimes referred to as shadow banks, too, these alternative financing sources. I know, and Christine made reference to this, there's now also an emerging trend. It's still very new. It's driven by some changes in the securities laws, but even non-financial institutions, now there are public offerings to finance individual projects. And so we'll see where that trend ultimately goes. Maybe it picks up steam. We'll see. But to what extent do you see the emergence of these kind of shadow banking and alternative lending market affecting the way that you'll be doing business over the next few years?
Part of my day job, or all of my day job, is actually capital raising. So I'm out talking to a lot of investors here, and been in Europe recently, and it's unbelievable how much demand there is for higher yield investments. International pension funds, local pension funds, all looking to find a way to increase their yields. And so I think that will continue. There's continuing demand and it's just bound to happen, and we'll, at one point, kind of turn our markets to the ninth inning. So stay tuned.
I would add that, Sabal Financial, we are a non-bank, non-regulated institution who places capital on behalf of institutional investors, high net worth families. So we're clearly a part of that. And, I think it's good in many ways. We're just an avenue to efficiently place capital, and we have real estate expertise, and, that should be a good thing. I will also add that it's interesting that, the banks, real estate was a dirty word not that long ago. Now they are jumping back into the market with a vengeance, and many of them don't want to staff up. They would prefer to buy debt from an origination machine, someone that they can trust has a solid underwriting platform. And we are in talks with several banks who have an insatiable appetite for product but don't want to staff up. So that's a phenomenon I think you'll see.
So the shadow, in that respect, the shadow bank market or alternative lenders may actually just be alternative originators, right?
Yeah, I would agree, yeah.
It's interesting. Something else that we covered a little bit earlier, and obviously there's been a lot of discussion today about Silicon Valley in the Bay Area, but there's also been some discussion here about other opportunities. So to what extent where do you see the opportunities outside of the Bay Area? And I know, again, we've alluded to that a little bit, but maybe you can share some of your insights about where you really see that and why.
I think for Wells Fargo, I mean, we're focusing a little bit more on some markets outside the U.S., which is something we historically had not done in real estate, but purchased a big portfolio from Eurohypo, and so now have a presence in London, and so I think we view that as an opportunity. Canada, we have some people on the ground there. And then beyond that, within the U.S., it's really sponsor specific, right? So if we have a client who's doing a deal in Sacramento, we're going to follow that customer. We're not, sitting down with a map saying this is where we want to lend more money. It's where are our good clients doing business and how can we support them?
Yeah, go ahead.
I was going to say, I don't know if there are opportunities, but if you're trying to make yield, you have to look outside of the gateway cities. And there are these are lower cost of living places. They are going to get more than their fair share, I think, of the job growth and the demographic growth, but they're also going to have the lowest barriers to entry and will be more boom-bust than sort of the gateway bedrock cities. So we're having to look at those markets that, if you want to go to LA, you can't be on the west side, right? You want going to Phoenix instead of, Silicon Valley. That's sort of the markets that we're in.
I would agree with Cynthia. I think if you have a big portfolio and you're focused on the major markets, at some point you're going to run out of dry powder. So we, a couple of years ago, opened an office in London where we've seen spreads just drop unbelievably quickly. We are considering Australia. We've historically done some lending in Canada. And we have operations in Japan because we have a large presence there from a liability insurance standpoint. So I think going international is one of the options. And then just as markets improve, going to some of the markets that were just really, hit really hard in the bottom of the market. So, Phoenix is starting to look better, and, Boise and Denver, a lot of markets that were tough are starting to look a lot better now. And I think the low cost of living does help.
And Sabal tries to be in markets that are not as crowded. Both JV and our debt space, we're focused really more on the small balance. On the bridge side, we're kind of up to 15 million. But I will say that market has become extremely competitive. We thought we were a leader in late 2012 when we got into the small balance bridge space, but by mid 2013, it seemed like there was a new capital source every week that had the same idea. So in that space where we have been able to make some traction and not see the world so crowded is in deeper value adds or higher leverage, a vacant office building, for example, a change of use, are going up to 90% of cost if we think there's 75% of value at the end of the day. So that's where we've gone to with respect to bridge debt. On the equity side, same thing. We want to be where there's less efficiencies, and that's the small balance JV space, kind of that sub $10 million space. There's a whole lot of capital sources that are out there banging heads above 10 million. Less than 10 million, it tends to be the family office and the sort of high-touch friends and family capital network. And so we come in as a nice alternative to tell our sponsors, hey, you can just focus on executing business plans and acquiring property, and you don't have to manage that friends and family capital network that can be fairly high maintenance. So those are the areas where we think the least amount of efficiency is and where we can make our mark.
Very interesting. I'll just note that as an attorney, obviously we're at kind of a nexus point of a lot of different deals and deal activity, and it has been interesting to see ebbs and flows over the last year, where it's not uncommon in the course of a couple weeks to hear from different clients. In this case, I'm thinking of a number of California real estate investors, or traditionally California real estate investors, who all of a sudden have an appetite for kind of a similar geography in a completely different state. And that's now happened, I can think of several times just over the last couple months. So I do think that there are geographic presences and opportunities that start to pop up, and everybody's chasing yield, moving around. So I'd like, in some of the remaining time that we have some terrific panelists, and I know some terrific audience members here. Perhaps you have some terrific questions to share too. So we can open that up and give you folks an opportunity to talk to some of the premier lenders in the world.
Thanks, Andy. I have some clients that have contaminated property, and they would love to get financing. How do you deal with brownfield properties? Do you loan on them? And if so, what are your criteria?
Fortunately, we have several engineers that handle a lot of that. I think you just have to check around and be familiar with the different lenders. I think there are different standards, especially as it relates to environmental. There's a number of lenders who are really tough on it, and others that are more pragmatic and have more experience and understand what the risks are. We've been fortunate never, in my knowledge, to have a real loss due specifically to an environmental issue. I don't know if that's because we're careful or because it's not as big a risk as people perceive it to be. But I think every lender is different in that regard. And there's always, the recourse component of, so if there is an issue, we're going to want the strongest borrower we can find, if we're going to take a risk on that front.
Okay, Andy.
Hi. I'm with Exchange Bank in Santa Rosa, and we're a really old lender. We lend all around the Bay Area and in Sacramento, and we compete with some of you on things. So my question has to do with the Chinese. Nobody's talked about that at all today. We understand that they've made some really major purchases all around the country with Chinese money. And I'm wondering if any of you can address their purchases, if you've been up against them in competitive situations, what you might have to say about their entry into the U.S. commercial real estate market, and also, by the way, in the Napa Valley winery and vineyard market, which we're really aware of up in the North Bay. Thanks.
I think it's a really good thing. And you're seeing it in, a lot in San Francisco. I think it's just a testament to this whole area being, becoming a more institutional, and so there's more capital flowing. So certainly on the residential side, we had looked at a large condo project going in that ultimately ended up with a big component of Chinese equity. And I think, the expectation is probably that project, may have more interest from people coming in from China, whether they're children or second or third homes. I actually think it's a real positive, and they're filling on the Chinese banks, I think, are filling in some ways a void that, the German banks have left, the Irish banks, they're not in the market anymore. So anyway, I think it's a positive. I think it's positive for the U.S. and especially this area.
I think the Chinese have really not been a factor. I mean, they did the one deal in San Francisco, and they've made 2 or 3 large loans in New York. And I certainly agree that the more, the more lenders, the more equity, the more robust our economy will be. I think it'll lead to more development, which might not necessarily in the long run be good. But my experience has been a lot of talk about Chinese. We own some pretty high-profile sites. We've historically owned Mission Bay. We own another really large, high-profile site on the Upper West Side of Manhattan. And we've gone to the Chinese, and maybe they just didn't like what we had to offer. But there've been much more aggressive sovereign wealth funds and foreign investors in the Chinese in our experience.
My sense is primarily development, and we have so many hungry investors here that I don't think they're competitive on a standard core sort of deal. Maybe New York in a few instances, the highest trophy kind of level properties, like you saw in the GM building, but other than that, it's not a big factor.
We've seen in the small balance space not too much activity, but occasionally we'll see a pretty impressive by the pound buy by a Chinese family that's now got a business plan and looking to transition the asset, but very little activity really.
I'll mention one twist, not exactly on point, but we have seen and do see through, and some of you may be familiar, how many have heard of EB5 financing out there? Okay. So we have seen through the EB5 financing market, and it takes only a certain subset of projects to qualify for that. But it's basically a market, for those of you that don't know, where foreign investors can actually get a visa or get on a fast track for getting a visa by actually investing capital in certain qualified projects, and there's a whole legal framework around that, but it tends to be very, very low cost capital. And so for those projects that are eligible for EB5 financing, we do see quite a bit of that, and it is largely funded by, again, folks in China looking to actually take advantage of the visa opportunity.
What are you guys seeing on the LP side as you're raising capital for your funds beyond chasing yield, or any sentiment out there, reallocations on the institutional LP side?
I think that LPs are interested in partnering with operators. There's a real sense that allocators, which I get bucketed with reluctantly, are adding an extra layer of fees. I think LPs are also very interested in Europe. I think that they have a view also that there's too many funds in the world, and they're much more focused on pairing their managers than adding to their list. So I would say from the LP standpoint, the general view is it's sort of late in the game. And the one thing that they were all talking about last year that they're not talking about anymore were the home deals, where the big rent, the big buy 6,000 homes, take it public play. That was one popular subject that seems to have fallen off the face of the earth.
Yeah, I would say one area that remains popular, and it's about gained popularity, and Rocky, you probably know better than me, but in the core space, the large operators such as Prudential and a JP Morgan or Invesco, they've all gone in 2009 to having a big, withdrawal queue, now have a queue to get into the funds. And I think mainly that's, the large institutions looking to, seeking returns, real estate returns. I think it's very different from the kind of higher leverage private funds that you see out there.
I think we have time for 1 or 2 more questions. Everybody wants a drink. All right. Well, thank you very much. I am buying. That's right. On me, on the house. So
Thank you, Tony. And I want to thank our panelists. The bar is set up right over there. I think they're setting up right now. If you want to take a break for a few minutes, there's
Head over.
Sorry?
Go ahead.
It's open, right? The bar is open. It's a full bar. We have appetizers. Great crowd. Thank you all for coming, and we'll see you next year. Thank you.